Bismillah ar-Rahman ar-Rahim. Today I'm going to talk about the stock valuations. And we will start by the logical process of securities valuation. The main objective of this chapter is to determine the intrinsic value of the stock. The intrinsic value means the true value of the stocks, or the actual value of the stocks. You should differ between the market value of the stocks, the book value, and the intrinsic value. The most important values to the investors are the intrinsic values and the market value, because investors, they compare between the intrinsic value and the market value. The market value is traded or is available in the security exchange market. The intrinsic value is calculated based on different models, including the capital asset pricing model, CAPM, FAMA, and the French, and other models. The valuation of stocks includes many processes. The first step in this process is to evaluate the economic environments. The economic environment for a particular stock. If you are talking about the Baltil, for instance, you should evaluate the economic environment of Baltil. Baltil living in West Bank and Gaza Strip, so you should know the economic environment of the West Bank and Gaza Strip. The economic situation is measured by different proxies, including the inflation rate, unemployment rate, the interest rate, and the geopolitical environment of the underlying place. This is to help you to determine the economic risk or the political economic risk. Because if you don't know about the nature of the economy, you may face some challenges. For instance, when we said investment in West Bank and Gaza Strip, you know, the nature of this place is not stable, and there is a lot of challenges, and there is some instruments fit to the challenges in Palestinian territories. If you want to invest in Brazil, it's different. Or if you want to invest in Jeddah or in Riyadh, also it's different. So first of all, you should think on the environment before you are focused on the stock, and from there you can go to the next step. And the next step, evaluate the regulations and the legal environments. From the financial and from managerial perspective, the investors, they have challenges in understanding the legal framework of the investments. I did a research in the 2-3 months ago, and inshallah we'll present this research on the new conference. What we conclude in this research, people, they don't have the superficial, the investors, they don't have the superficial understanding for the legal framework of doing business. For instance, they don't know about the tax law, the labor rights, the workforce rights, the insurance, all of these things related to the regulations. They don't have an in-depth, or let's say the superficial understanding to start up the business. The importance of regulation influence on the supply and demand of the underlying company. When the government intervene in a particular sector, it means they may motivate this sector or slowing down this sector. So the government, when they put their nose on the economic picture, they may change the style of this economy. So again, when you are starting up the business or thinking in investment, you think about the investment environments and the legal frame environments. which is not considerable by the majority of the investors. And this is why I'm focused on this area. And after this, you move to the various sectors of the economy. If we talk about the West Bank and Gaza, in terms of the instability of the economy, we have some sectors are growing up and some sectors going down. So try to investigate these sectors in the basis of the comparison between different sectors. And in this, you should analyze aware of the degree of competition, the competition between the sectors, cost structures. For instance, if we talk about Gaza, we have high cost for the industrial companies, but for the services companies, it's considered as a lower cost comparing between the industrial and the services companies, because of we are living under siege and the export and import is not available for the companies. So the services penetrate the market, and they don't need the borders, and they don't need the regulations or the tough regulations by the Israeli occupation. So this is very important when you considering on the cost structure of the underlying business. And the pricing environment, the anticipated growth. So you should put the different sectors in front of you and see the growth of this sector and this and this. Then you decide in which sector you are going to invest. And this is matched with the one of the theory, the recent theory in finance. They claim that the investments is not necessarily to have to distribute your fund in different areas, and they came against the Markowitz model. They said go and do analysis for the different sectors and invest in the sector that's have high growing. So this is the idea in one of the theories. So such background is necessarily prior to analyzing the individual firms. So is things going like this? You start by the total environments or the economic and political environment, which is geopolitical environment, then the legal framework, then go to the sectors, then you go to the individual stocks or individual security. And the last step, securities analysis, progresses to consider specific firms. For instance, if you talk about services, we have different services, including insurance companies, banking, coffee shops, internets, facilities, telecommunication industries. So which one you are interested to invest? Again, you go in-depth analysis and do competition between them, and anyone won the game, you can invest in the underlying firm. So ultimately, the purpose of the analysis is to determine if the firm's securities, stocks and bonds are undervalued or overvalued. So if it is undervalued, you buy the stocks. If it's overvalued, you sell the stocks, or you go long or you go short. So these 4 steps are important to determine the process of valuation. And these process remind us with previous chapters when we talk about the process of forming portfolios, starting by setting objectives, then setting the alternative of investment, and consider the taxation, and finally forming the portfolio. And this process is matched with the process of forming portfolios. So we should move in parallel when we evaluate and taking the investment decision. Now, the main leader to the investors is the return, and from the return we can determine whether we can invest or not. And I think you should have experience with this, but just to remind you, with this equation being discussed in chapter 2 and 3, chapter 4. Just to remind you, this is the expected return of a particular stock then is a function of two things: the function of the dividends, which is the income, and the function of the capital gains with the stock, with the growth. My question is from where the growth is coming from. This is the big question in this chapter. The growth is coming from the appreciation of the price. Again, from where the appreciation of the price coming? Okay, try to think. So G, from where the G? What is the function of G?
1 minus P0.
1 minus B1 minus B naught divided by B naught. This is correct. Now, what this important for you? Why B1 is growing? For instance, if B1 equal B naught, so there is no growing. There is no growth in the business. Now, my little question: why B1? Why we expect B1 to increase more than B naught? So you are buying at a price B naught and selling at a price B1. You are buying at 4 and selling at 6. The question: why 6 increase? So again, in different way, we are asking why this stock grow from 4 to 6.
The demand of the stock increases. People purchase this kind of stock increase.
Yes. Let's see, apart from other factors, focus on the fundamental factors. Be careful. When I'm saying fundamental factors, it means things related to the cash flow. When I say other factors like behavioral factors, is related to the investors. To the investors. Okay? So now let's go back to the question. In general, why the price growing from 4 to 6? Because of the competition. Okay, why the competition? Okay, you compete for what? Why? For the products, you are competing for the quality of the products. You are competing for the price of the products. But for the stocks, why you are competing on the stocks?
For the higher return.
For the higher return. Again, the higher return is having two sources of return: the capital gains and the income. It's like you are moving in the empty circle. Now let's fix things in your minds. Why the price is going from 4 to 6? It means there is a capital gains in here. But this is related to the dividends policy. I'm saying this is from the fundamental point of view. I'm not saying from the behavioral finance point of view. So the fundamental theory says the G is a function of the retention ratio. And I will go in details about the retention ratio. Retention ratio is the complement of the payout ratio. Okay? It is the opposite. Yes. So, this G has a positive function of retention ratio. So, what is then retention ratio? Retention ratio in this case, it means like reinvestment ratio. Reinvestment of what? Reinvestment of the retained earnings. So, when companies, they retain their earnings, it means this is a good indicator for the business to grow up. And this is why you observe the price is going from 4 to 6. I'm not saying just this, the growth is in one day. I'm saying if the price was in 2012, then the price in 2013 jumped to the 6. In this case, what we observe, the price is growing from 4 to 6 as a result of the retention. Okay? Other factors are equal. Okay? So we fixed other factors. If a firm's 0.93 dividends is expected to grow at 7% to 1, and the price of the stock is $25, the anticipated annual return on an investment in the stock is, just apply this equation. Okay, so the expected dividends 0.93, and the growth is the difference between 1 and it's 7%. and the price of the stock is $25, then you can get the result. Estimation of growth rates. The estimation of growth rates, we have different methodologies of estimation. By the way, for this previous, you can go back to the chapter 4. I don't want to go in details about this because I detailed this. And this is not our objective in this chapter, just to loading the chapter or integrate you to the chapter. Estimation of the growth rates, and this is again this is related to the financial management. An estimate of the firm's derived or the dividends growth rate is used in dividends growth model. We can apply the dividends growth model, and the dividends growth model. We will go to investigate this. D1 divided by KS minus G. This is the dividends growth model. So if you know dividends, you know the required rate of return, and you know the price, you can estimate the growth. We will go back to this equation. Estimate often based on accounting data. How you do this? For instance, you can bring the price of a particular stocks in 2010, for instance, $9, 2011, 2012, for instance, 2013, 2014. Now you can calculate the growth rates. Just to explain to you how it works, on the chart we have 2010, 11, 10, 11, 12, 13, and 14. Look what the growth means. In 2010, we have $9, the price. So 2, 4, 6, 8, and 10. 12. In 2010, we have $9. The price was $9, which is in here. 2011, $11, which is in here. 2012, $10. It's in here. 2013, 11. This, okay. Then 2014 is okay, $13. It's in here. Now you can think of this. This is being taken from different years, from 2010 till 2014, and just connect the lines. Now, the price is starting from this point and ending with this point. What is the growth? The growth, you can take this, and this is the growth. By using your experience in mathematics, you can estimate the slope of this, and you find the growth by using the regression analysis. Or you can use some mathematical tools. You can go back to the financial management or to statistics. It's things easy in doing this. Okay, so this is the stocks, the growth of the stocks. So the growth is a function of the time, because to grow from 9 to 13, it takes 1, 2, 3, 4 years. So it is a time. It is a function of time, and is a function of the starting price and ending price. The good news, I'm not asking you to estimate the growth in this course. Okay, this is the good news. The bad news is to understand this. Okay. The good news, I'm not asking you to do the calculations, because the calculations is the calculation related to the financial management and the statistics. Okay, so you can go to the historical earnings or dividends payments, the same. Just go to the historical data and apply the growth. Now, what is the impact of increased growth in the stock price? What is the impact of the growth on the price?
Increase the price.
We will see then, yes. So increased growth should increase the stock price, but increase the expense of dividends, it means increase
Payout.
the dividends, the payout ratio, then may reduce the stock's price. Okay? And again, I explained this in the previous, in chapter 4 and chapter 5. So, what do investors want? They want growth or income or a mix of them. Okay? And we handled this question in the previous chapter as well. When we talk about we have different stocks, we have growth stocks, we have income stocks, we have defensive stocks and other stocks, and investors are in a challenge on select which stock they can invest. Okay? So, the question of what is the best use of the funds is the question related to the retention versus the distribution. Because retention is growth and distribution or dividends is income. So whether the people or the investors prefer to have income or to have growth or both of them or other things. The source of funds, which is related to the policy of dividends or the dividends policy, the dividends could be regular, could be extra, and could be irregular. Regular, it means stated dividends like this. This is regular. The extra is moving like this. Look at this chart. You can look at this chart. It's going like this. Look. For instance, this is in 2009, 2010. Then in 2011, we have extra profits or net income. Then the company decide to pay out more dividends to the investors as a complement to the investors. They have extra income. I experienced HSBC in 2011. They paid extra dividends because they have more income than the normal income in the previous years. So they is moving like this chart. But irregular, it's unstable. It's going like this. Look at this chart. Unstable. Maybe in one day no dividends, high dividends. Dividends average is things is highly fluctuated. So again, we have the regular, we have extra and irregular, and I add there is zero growth. So zero growth is going like this, which is zero growth. And this is related to the charity organizations. There is no growth in the price. Okay? Any question? Okay. And we should differ between the short and long-term capital gains. Short, it means you are buying and selling within a limited period of time, less than 1 year. The long-term investment, it's more than 1 year. The advantages of long-term investment is the subject of lower tax, okay, than the short-term investment or short-term capital gains. However, for the transaction cost for the investment relative to the dividends is high because you are paying commission for buying and selling, but the dividends paying high tax. So people cannot take the beauty of everything. Okay? So it is a package of having the long-term investments. Yes, it's paying less tax but high commission. For the dividends, paying higher tax and less commission because there is no buying and selling in the. You will see this matrix. For the dividends, high tax or higher tax. For the capital gains, lower tax. Short term and long term, no commission for selling and buying. There is a commission for selling and buying. So people, they should compensate or trade off between the dividends and capital gains. But generally speaking, the capital gains in total have the lower cost, considering the commission and the tax. Okay, so this is why people, they do prefer the capital gains. I'm not saying I mean the investors. I'm not saying for instance, the retired people. Now, let's go back to our story related to the valuation of stocks. As I explained, we can categorize the dividends policy based on the constant growth or the non-constant growth, as I explained in the previous slides. And it has a reflection on how we evaluate the stocks. We have a general model known dividend growth model. This dividends growth model is a well-known model to estimate the price or the value of the underlying stock. And the results or the output of this model is similar to the output of the CAPM, capital asset pricing model. Okay, but the capital asset pricing model is not considering the capital versus the income. Okay, so this model considers the both of them. So other model, free cash flow methods, is calculated the discount cash flow. The third model using the multiple of comparable firms. I will focus on the first model in this chapter. So the stock value, look at this stock valuation. So the value of the stocks, this is the price of the stocks, the initial price of the stocks, which is today. I'm not saying the price for the next year or the third year. The B notes means now, the price of the stock now, or the initial price from today, is a function of the cash flow. So the question is, the cash flow is coming from dividends. And dividends is coming in different years. So this is dividend ones in the end of year 1, dividends 2 in the year 2, 3 at the end of year 3, and dividends alpha for the alpha. So when investors estimate the value of the stocks, they estimate the cash flow of the stocks. So the higher the dividends, the higher the value of the stocks. And relative to this, they compare the value of the stocks with the required rate of return, KS. Please be attention, because I'm asking about these things in your exam. I will ask you about these functions again. So the B note is a function of two things: the cash flow coming from the dividends and the required rate of return. So investors, when they invest their money, they think in two things. First, what is the cash flow coming, and what is my required rate of return? And the cash flow is a negative function with the required rate of return. Is a negative function. Look, this opposite to this, relative to the price. It means if this increase, the price decrease. But if this increase, the price will increase. Try to formulate these things in your mind, please. Read it carefully. Okay? And so this is moving from D1 to D2 to D3. As I explained, D2 could be a function of D1. Pay attention, please. D3 is a function of D2. We claim that in terms of the nature of stocks, we could have a constant growth, we could have non-constant growth. Okay? So, if we have a constant growth, then D2 is a function of D1. and then D3 is a function of D2. What it means is a function. It means, for instance, D3 is a function of D2, 1 plus the growth. Okay, let's go back then. The D node, D1, is a function of D nodes 1 plus G. Okay, so dividends is the initial dividends. In order to estimate the dividends in the year 1 is the dividends in the beginning of the year, okay, 1 plus the growth rate. You can observe the importance of growth rates. We assume that the growth is growing as a constant. Okay? So, one whose dividends are expected to grow forever at a constant rate, G. As I explained, so then D1 is D naught 1 plus G over raised to the power 1. D2 is D0 1 plus G raised to the power 2. dt, d at t time, and any t, it's equal D naught 1 plus G raised to the power t. Then if G is constant and less than the Ks or Rs, the required rate of return, then the formula is going like this. The price, the initial price, which is today, is equal to D1, this is D1, D naught times 1 plus G is D1, divided by the required rate of return minus G. Okay? Then you have D1 Ks minus G. Again, the price is a function of dividends and a negative function of Ks and positive function of G. Okay? Again, the price is a positive function of dividends and negative function of the required rate of return and positive function of G. Because look, G here is a minus and is deducted from the Ks required rate of return, then it is positive function. You can look at this chart. We have constant growth. This is in positive. We have negative growth. If the dividend is fixed, there is a difference between constant. Constant is like this. Fixed is like this. So this is constant growth. And this is fixed growth. So there is no growth. The growth is 0. So when the growth is 0, we don't have G. So the value of the stocks is equal to the dividends, any dividends, divided by the required rate of return. And this reminds us with the preferred stocks valuation. Okay, this equation, typically the preferred stocks valuation. Go back to the slides and you will know. If a stock pays a dividends of $1 and the investor's required rate of return is 12%, it's very simple, just 1 divided by 12%. So the price is 8.33. Okay? Okay. So, if the dividends grows at a constant rate, the previous one is a fixed rate, but this one is a constant rate. Just remind you with the equation, V naught 1 plus G is this is D1 divided by K naqis, okay, minus the growth rate. You can calculate the intrinsic value. If the D naught is $2 and the KS or RS is the same, is 13%, and G is 6%. Now, what is the price or the intrinsic value? The price is equal D1 divided by KS minus G. D1 is D naught 1 plus G divided by KS minus G. Okay, this one, D, it's equal to 1.06 divided by 0.13 minus 0.06. I know you have good experience on calculation, so it will be 30.29. So the intrinsic value of this stock is $30.29. Okay? Any question?
No.
Are you sure no questions? Okay. This is. Let's go back to the question, to the initial price. If I want to expect the price for the next year, which is B1. If I want to expect the price for the third year, which is B3. Or if I want to expect the price of after 50 years, which is B50. Okay? Again, you apply the same formulas. Let's see this one. B1 is D2 divided by KS minus G. And this D2, just to deconstruct,
D1
is, yes, D1 or D0. If write D1, it's 1 plus G. If you write D0, it's 1 plus G raised to the power 2. You either use this one is right if you have D1. If you don't have D1, you still have D2, D0. Then D0 is a function times by 1 plus G raised to the power 2. If I want to calculate, for instance, B5, the price in the fifth year, D6, yes, divided by K minus G. That's it. Okay? So the dividends growth model depends on the following parameters. The required rate of return, it has a negative function of the price. The dividends, positive, and the growth is a positive. Because the more you growing the capital gains, the more the price moving up. So value depends on the three: the required rate of return, the growth, and the dividends. The required rate of return, just things going together now. The required rate of return reminding you with the calculation of required rate of return, which is a function of risk-free, it's CAPM, capital asset pricing model, the market return, and beta. Okay? My student, you revise the chapters. Okay, we hope. I know it is not big yes. It's very little yes. Just to remind you with the required rate of return, RS or KS, it's equal. The risk-free plus the RM minus RF times beta. This is, and just to remind you, in addition to this is assuming the market is efficient. If the market is not efficient, we should estimate Jensen's alpha. We should estimate Jensen's alpha. Yes, we know. We know this is sahih. And then Jensen's alpha is calculate the difference between and the market return and the actual return. You see, please try to narrate this story. Try to narrate this story. If you fail to narrate this story, it means you are in the challenge. Okay? We know this. The required rate of return, KS, depends on three things. The stock beta, okay, the return on the markets, and the free rates, the risk-free rates. Okay? So just to remind you with the required rate of return, you're observing. So the risk-free is 9%. The market return is 12% and risk-free and beta. And you can estimate beta by using the slope and regression or other functions. Okay? Any question?
No.
No question. Okay, inshallah we will finish this chapter today if you don't have question. Any question? Yes. Okay, go. Okay, now let's talk about the PE ratio. Other alternatives of the valuations of the stock, because investors are using different valuation or different techniques or different approaches. One of the most important equation or valuation is the PE ratio. The PE ratio. The PE ratio is stand for PE is equal the price divided by EPS, earning per share. Okay? Now, so this is the PE equal the price divided by EPS. If you want to estimate the price, so what is the price? Use your experience in calculation. What is the price?
Multiple earnings.
So the price, just move this. The price is equal PE times EPS. Look at this equation. Please. Look at this equation. This PE is considered as the multiple of the earning, which is M. So the price is equal M. M is stand for the PE times EPS. The high M, the higher the price. Okay? The higher the M, the higher the price. Is the PE. I told you. The price divided by EPS. Yes. Okay? Sorry? Okay. So, if the analyst determines the appropriate PE is 10, it means M is 10, the multiple is 10, and the firm's per share earnings are 4.5, the EPS is 4.5, what is the value of the stock? Just very simple. 10 times 4.5, which is $45. Okay. Do this. You end with the $45, the price. And try to use CAPM, capital asset pricing model. And try to use the growth model or growth dividends model. And bring all of the results together and compare between them. You observe little difference between the three models. Okay? Let's go back to the PE. How investors evaluate the PE. Okay? PE, it means if PE is $10, it means in order to have $1 profits, you pay $10. When the PE is $15, it means having $1 profit means to pay $15. So in this case, this is cheaper than this in terms of the price. Okay? Still, the PE ratio has a problem or has some challenges. So the weaknesses in the use of PE, different definitions of earnings. What is the earnings that you are talking about? The net income or the EPS, earning per share? Or you are talking about the operational income? Or you are talking about the return earnings? So differences in estimated earnings, I mean the calculation of earnings, question of the appropriate multiple. the M, what is the appropriate multiple to calculate in the beginning of the year or in the end of the year or in the middle of the year. Okay, price to book value. Just divide the price by the book value. Conceptually, the same as using the PE ratio. It's the same. And the same weaknesses. Just divide the price by the book value. The book value is the book value of the underlying stock in the accounting data. Standardize the PE ratio. This is one of the solution. The PE divided by earning growth by G. So low PEG ratio below 1 suggests undervaluation. And if it is higher 1, it is lower valuation. Okay? We will stop here. Okay? And approximately we finish this chapter. Okay, inshallah, next meeting, because I observed my students